Hey folks, welcome back. So in November last year, I was really excited to buy this e-commerce stock, Lightspeed. It's a really fast-growing company, so when it dipped, I picked up 100 shares at $70 each. Its earnings are usually higher than expectations, and analysts have a price target of $85. So I thought it would bounce back pretty quickly, and I bought in at a good price. But oh man, was I wrong. It continued to drop over the last month or so and is now trading at just $36 per share. So I've basically lost half my $7,000 investment. But as the saying goes, it's only a loss if you sell. So in this video, I'm going to share what my plan is to turn this into a winning trade instead of selling it at a loss. And if you think I'm going to double down on my position, you'd be right. Normally, in this situation, I would simply run the wheel. This is when I sell a put option to earn some income, which is what I did in this case, and I set a strike price of $70 when the stock was trading at roughly $90. And on expiration, it just so happened that the stock fell below my strike price, so I was obligated to buy 100 shares at $70 a share. Once the put option is assigned, the idea is to sell a call option to earn some more income while I wait for the stock to go up. And maybe I'll set a strike price of $80 so I can make a profit in case it gets called away. Just like a put option, most of the time these out of the money call options will expire worthless. But if it gets exercised, I will no longer own the shares and then I can repeat the cycle all over again. So even if the stock doesn't move up or down too much, I would always be earning premiums from the time decay of selling options. In theory, this works very well. However, if a stock falls 50% or something, it's going to make it very difficult to run the wheel profitably. So let's see why the wheel doesn't work for my Lightspeed trade and what I plan to do instead. As the wheel suggests, after the put option was assigned, I'm supposed to write a covered call. And that's what I did. I wrote a call option with a strike price of 80, and that netted me about $75 in income. And this was right after I got assigned the stock. So at that time, Lightspeed was still trading at about $60, $70. So the premiums on this call option was still pretty decent. But within days, this call option is going to expire. And the good news is it'll expire out of the money. But let's see what happens if I try to sell another call option today. This is barcharts.com. I've talked about this website before. So we're looking at the Lightspeed call option here for February 18th. That's 35 days away. If I were to sell another call option with $80 strike price, you can see there's no interest for it. This is the theoretical value of the option if I were to sell it. $80, $75, still nothing. My cost basis is about $70, right? Because that's the price of my put option strike. So that's how much I bought it for basically. So I would have to go all the way down to like 55 or $50 for there to be any meaningful premium for me to earn here. But of course, if I, sell it at this strike price and it gets called away, then I'd be taking a loss because I would have bought it at 70 and sold it at 55. So I don't want to do that. So what I'm thinking is instead of running the wheel and selling a call option, which is not going to be profitable in this case because it is just too far away from what I need it to be at, which makes sense. I mean, the stock is at $36 today. Like, what are the chances in like just over a month it'll jump to $80? Not very likely. So, that's why the buyers of this option they're not willing to give up a lot of money for this. So what I'll do is go down to the puts and basically double down on my position is if you look at the strike price at 30 or $35, remember the current price is 36. So if I sell a put at 35 or $30 or even 25, you can see I can make some pretty good premiums here, even though it's just theoretical. And with a $30 strike, the delta is minus 0.21, so there's a 21% chance it'll hit that, but not very likely. So that is a pretty solid strategy if I think that the stock is already cheap today. And if it drops to 30, then that's even better. And that's exactly what I did. About a week ago, I sold another put option on Lightspeed, this time at $30 instead of $70, like my last put option. This one's expiring on February 18th, and I earned $170 in premium, so not bad. As you can see, it's already paying off. The option has already lost 24% of its value, roughly $18. That's pretty good. This is going to lower my overall cost basis for Lightspeed by about $170 or roughly $1.7 per share, right? So instead of buying it at $70, it would be like I bought it at, $68.3. And if you count the other premiums I've made from the two other options I sold, my rough cost basis is about $66. So let's take a look at what could happen. If Lightspeed continues to trade above $30, then by the time this option expires, I would simply write another put option for $30 or whatever it may be at the time. Or if it, by February 18th goes up to like $60, then I might just go back to the wheel and sell a covered call on it. The idea is to continue selling options on this, either put options or call options. Either way, I'm making a premium, and as I'm making the premium, I'm essentially lowering my cost basis until eventually my cost is so low I can write a call option at $50, and if it gets assigned, I would still make a profit. So in this scenario, it's more about just having patience, and I don't see any situation where I'm not going to make a profit as long as I have the time to continue to sell options on this. Now, the other scenario is Lightspeed actually falls below $30 and my put option gets assigned again, and I would be on the hook to pay $30 a share for 100 shares. So in that case, I would own 200 shares of Lightspeed at a cost of, roughly $50 because I bought half of it at a 70 and then the other half at 30 plus whatever premiums I got you can subtract from that $50 cost basis. But anyway, let's say about $50. Well, if I think the stock is undervalued and eventually it's going to go up, then, that's not a bad thing either, because instead of having a cost basis of 70, I now have a cost basis of 50, which means the stock needs to go up less for me to break even. That's what Charlie Munger did recently with his Alibaba shares, where he basically doubled down. So those are the two scenarios. Either I continue writing put options until the stock goes high enough for me to wheel my way out of it, or I lower my cost basis and wait for the stock to appreciate for me to make money, and of course continue to write options and make premiums. So no matter what happens, I expect to make a profit from this trade eventually. Now, there is, of course, one scenario which is very unlikely, where I can, lose basically everything, and that is, of course, if the stock price goes all the way to zero.
Uh-oh.
I don't think that's going to happen. The company does have pretty stable economic foundations. According to Morningstar's quant report, its fair value should be at $67, and the last time it traded well below its fair value, which was back in 2019, it bounced back up to meet its fair value pretty quickly. So I expect the same thing to happen this time, but even if it takes a while to eventually be valued at its current worth, I'm okay to just wait it out. I like this strategy because even if you're not into actively trading options regularly, you can still use this to turn a bad trade into a potentially profitable trade. Finding opportunities even in seemingly bad situations is one of the skills that high net worth people tend to have, and I'm trying to use this more in my own life. This is one of the habits I talked about in my other video on how wealthy people behave. In any case, the implied volatility on Lightspeed is relatively high right now, so that's really good for option sellers like myself. So hopefully this goes well. Thanks a lot for watching. I hope you got something out of this, and until next time.